What's going on, everybody? Welcome back to another live stream. I know I'm about 7 minutes early here, but welcome in. Make sure you guys hit that like button for us on the way in, and big day for crypto. Hopefully everybody out there is doing fantastic. Hanging in there right now. The markets are just very shaky right now. A lot of people are just kind of awaiting this big moment. It does look like we're going to get a 75 basis point move. Usually we get the news before the actual meeting, but we get the movement in the market. Oops, just drilled my mic. We get the movement during the market, movement in the market during the actual press conference. So right now, crypto's relatively flat. We are coming up slightly here in the last hour or so. The data from CoinMarketCap has not been really doing a great job for me. So I'm using CoinGecko here. We'll see if they update this over on CoinMarketCap's side of things. Let's see here. Looks like it's updated now. Okay, so Bitcoin is moving here a little bit. Oh, there's another little bump up. So that's good to see. Bitcoin is over 20,600. We did dial back to about 20,300 leading up to the news here this morning. So a little bit of a burst. Ethereum making some moves here. It's up 1.72% in the last hour. So Ethereum is, again, driving the market here. It's early. We're going to see how this all plays out. Welcome in, everybody that's just bouncing in here. Glad to have you with us. We're going to listen to Jay Powell, provide some comments around it. It's going to be a lot of fun. So welcome in. Just getting set in the saddle. I might have to go get some more water here, but a little bit early. But we're ready for the 2:30 meeting. We've got it all pulled up, ready to go. We're going to watch it live together and break it down. So welcome to everybody in the chat. Let me see who's in here. And Travis said, enjoy Tampa. Yeah, I went to the Lightning game last night. I'm all over hanging out down here in Florida, man. It's beautiful. Beautiful state. Travis, I know you're from my neck of the woods, getting down to Florida, man. Fantastic move, no doubt about it. Forrest says 0.75 is confirmed. Yeah, that's what we're seeing. So if we go Federal Reserve here and we sort some things. So here it is. Watch your gurus all over it. Breaking, Federal Reserve raises interest rates by 75 basis points. So that's what we had talked about this morning. I think this is mostly priced in. We might get a little bit of a boost. I'll be super shocked if we get a big boost. But this was my bet. If I was a betting man and you could have some odds on this whole thing, odds are that it was going to be a 75 basis point move. And I think what's going to come with this could move the market higher, though. I think it's going to be a 75 basis point move, which it is. We mentioned that this morning. And also some positive sentiment for December and to close out the year. I think they're really going to make it a point to go out this year on a high note. Hey, listen, it's not great yet, but man, look at all the ground we covered from June until now. Look how much we've done. I think that's going to be part of the narrative here this afternoon as we listen to Jerome Powell. We shall see. We'll break it down for you, of course, as we listen, and we'll see what the market's doing in response to Jay Powell coming in. So speaking of coming in, a lot of people coming into the live stream. Welcome. Wherever you are in the beautiful world out there. Good evening, good afternoon, good morning, depending on where you are. So why did crypto pump after that announcement? Well, it's not pumping too much just yet. I mean, we're getting a little bit of a move. Let's see where we're at now. Ethereum. Okay, now Ethereum is moving a little bit. Now we're up almost 2% in the last hour. Let's see some big movers. Litecoin has actually been on the move. It's up 11%. Let's pull up TradingView over here too, and we'll track Bitcoin and Ethereum on this side of things. Actually, let's take a look at SHIB first. SHIB, a little bit of a move there. There's Shiba Inu here in the 5-minute. This is a 5-minute look here. So there's SHIB on the move a little bit. Let's look at Bitcoin here in the last little bit here. Similar move. 20,700 now for Bitcoin. So again, this critical number for Bitcoin that we need to get back up to is 21,000. We need to sustain 21,000 if we want to see 24 and 25,000. That's our critical level. That's why when we got up here at 21,000, here it is. We topped out at 21, but look, we weren't able to sustain it right up in here. See, this is 21K. Right where my cursor is. That's 21K. But look, we've dialed back down. Now, will we go back up and retest this? It's looking like it. It's looking like we want to. Big breakthrough here in the last hour, getting a 75 basis point move, which it's crazy, right? That we're actually getting a little bit of a market pump off a 75 basis point move. But hey, it's meeting with expectations. It's exactly what we thought would happen. And everybody in chat, Good afternoon to you. Good evening, wherever you are. Lazaro's in Miami. What's up? What's up? Let me know where you're from in chat. Drop in there where you're from. We've got about 13 minutes until Jerome Powell takes the stage. So we'll have that live for you right here. Make sure you stay locked in. Hello from Norway. What's up, man? What's going on? Gunther, how we doing? Let's see. Gala, Vet XRP. What's up, Brian? How we doing, man? Small boost. Nothing to write home about. Yeah, nothing yet. Nothing to write home about yet. But I'll take this so far. We are dialing back a little bit here. 20,600 here. Come on, Elon. Make a tweet about Doge. Yeah, that always helps, doesn't it? Hello, William. What's up? Alex, good morning, good evening, good afternoon. I'm here in Ohio just waiting. I like it. 330. The 330. I know where you're at. In the 330. Notice, please pay the Luna Seed devs a monthly income. Grizzly, I hear you, man. I hear you. I know that's been a topic of discussion. Dogelon's up 16%. Cheers, John. How we doing? Fort Lauderdale's in the house. Tampa, Florida's in the house. We got Canada in the house. Hopefully you guys can't hear that blower outside. We got AZ. We got Quebec in the house. We got a bunch of people popping in here. Southwest Ohio. What's up? John in Charleston. What's up? We got Romania in the building. Nice. We got Oregon, UK, Croatia, all across the globe. Absolutely love it. Arkansas. We've got Sarasota, Florida. We've got Salem, Oregon. We've got France in the house. Mari Red, thanks so much for the $5 donation. What's up, Zach? I'm at work. Thanks for the updates, like always. Mari, you got it. Thank you so much for being such a loyal supporter to the channel, man. Or not man. I know you're a woman. Sorry. I've made that mistake too many times. I'm sorry. Leroy's out in Vegas, Sin City, baby. What's going on? Bryce, Muskegon, Michigan. What's happening, Bryce? What's happening? I'm from where rockets launch in Florida. Boca. I know my man's always locked into the rocket launches for sure. Dayton, Ohio. The Flyers. What's up? Your loyal Patreon member here, Steve, my man. Appreciate you, brother. Appreciate you, man. Here from Florida holding 100 million SHIB. What's up, 12 Nation? What's up? We got Pakistan in the house, Texas, Detroit basketball, New Jersey. What's up? Boston in the house, Bostonian, facepalm. What's going on? San Antone. What's going on? All right. Bunch of people in the house. Muzz down there in Louisiana. What's up, Muzz? New Hampshire. What's up, man? New Hampshire. That's nice. I haven't seen New Hampshire. Mexico. What's up, Ricardo? How we doing, man? What's up? Saudi Arabia. What's up, Anonymous? How we doing, man? Sicily, Indonesia in the house. We got a bunch of people in the house. All right, let's see what's popping here. So that's the news, breaking 75 basis point. But now the real thing happens. It's this man right here. What's he going to say? And how will the market makers react to it? That is the big topic of discussion. All eyes on this guy here at the top of the, not top of the hour, but 2:30. 2:30. That'll be the big press conference that we're waiting. So let's go take a look at some prices across the board. Yep, we're seeing some movement here. And Bitcoin is 26 right now, 20,600. Just crossed over 20,700 momentarily. But again, Ethereum is the mover. It's moving the market right now more so than anything else. When we look at dominance, that's something we always like to look at. Let's see. Bitcoin dominance is down to 38.8%. Ethereum 19%. Pretty crazy. So BNB has also been moving up nicely. It was over 330 recently. Really like BNB. Love the long-term future here of BNB. Coming in from less than 300 down here at 286, popped up to about 330. There's a couple times crossed over 330. And it's heading in that direction right now. Should get back up there. A little bit of resistance there at 330 for BNB. We'll see if it can break through. We're long on Bitcoin over here. I like it. Please like and subscribe. Muzz, you know the drill, man. Appreciate you. Muzz, one of our community members, really our community moderators in our Discord. Appreciate you, brother. Love what you do. You've been rocking with us for a long time. It was a pleasure to meet you, too. Pleasure to meet you, Boca. Met a lot of my Discord members recently out in Daytona. So planning on doing some more of those meetups in the future, man. That's always awesome. Getting together, have a few cocktails and whatnot, and enjoy life a little bit. Zach, he is on now. Okay, all right, let's shift over and let's pop in there and see what's going on. Is he live? Is he already up there? He's not on right now. I don't have it yet. It's live at 2:30. So right now we've just got a jingle. We got a jingle playing that I don't want to play too long because we'll get pinged. But that's what we got right now. But we've got it covered here. We're locked in. Live at 2:30. We're going to get the FOMC conference. Can you cover Kronos? Yeah, still a big proponent of Kronos, Jack. Still love where they're heading. Let's take a look at where Kronos is right now. Let's see. Should be at around 11 cents or so. Yep, that's exactly where we are. At about 11 cents right now. And that's where we've been kind of trending, right? Down a little bit. But listen, man, I still love what Crow's building, their ecosystem. A lot of the exchanges and their tokens have taken big hits, and it's to be expected. But, this was our all-time high. You can't see that, can you? This was our all-time high back here when it hit almost 90 cents. So we're about, a 10x, 9x away from all-time highs. I do think we'll get back up there and above $1 next bull run, and probably above and beyond that. $2-3 might be a nice target there for Crow and their ecosystem. It's a fast-growing ecosystem too. They just crossed over a big threshold. I saw something. What did I see on Crow? It was something from Watcher, actually. Let me see if I can dial back and find it quickly here. I think it was late last night. Here it is. JustInCrypto.com. It was early this morning. JustInCrypto.com surpasses 70 million users. So, yeah, big proponent of Crow still. Love what they're building. Yeah, 75 basis points is going to be the move. That is the official announcement. So, yes, it's 75 basis points, everybody. That is the official announcement. 75 basis points is going to be the move. But again, we're going to get a lot of movement. We should get a lot of the movement in the market off of what Jerome Powell says, right? So that's what we're awaiting right now. We got to listen to this guy here. Look at that shit-eating grin he's got on. He's ready to make some moves, make some calls, shake the market up a little bit. You know what I mean? All right, so I got to get some more water real quick. Let's see. XRP and XLM will pump, Casey says. All right. Quant Gala H bar Lazaro, nice. Got a nice play, a couple nice plays there. Some ISO 22 plays, and got some gaming plays there with Gala. I like it. Crypto Noob, what's up, man? What's going on? Chainlink going to pump today as a new payment method news. Nice. I do like Chainlink too. It's been decimated as well, providing a ton of opportunities. Chainlink is an OG in the space. It's not going anywhere. And Chainlink is on the move a little bit, up 3% in the last hour. Let's sort it by last hour here. Let's see what's going on. Yeah, Uniswap, Doge back up 3.62%. Look at Algorand's up 4% in the last hour. Mina is up over 5%. Chainlink's right there. SHIB bouncing back into the 12.44 zone. I got a video coming out here after the FOMC meeting. There's a crucial level for Shiba Inu at that 4015 level. That's the level we need to get to. I explain why in the video after we get done with this live stream. That's coming out about 3:30, I think. So be on the lookout for that. Where to watch the live meeting? We're going to have it right here. Don't go anywhere. We've got you covered. We're going to break it down right here and watch it live together, FYQQ. So, yeah, we're going to break it down right here as we watch it unfold. And a lot of people are tuned into this, of course. A lot of people ready to see what Jay Powell has to say and what the narrative is. Because, folks, perception is reality. Perception is reality when we look at meetings like this. And people are going to hang on a particular word or a couple different words that Jay Powell says, and that is going to be the narrative moving forward for us for the rest of the year. So, again, we're setting the stage here. I hope we hear something about December as well. What I think will happen is that, I don't think this 75 basis point will be the real reason why we move if we do move. I think it'll be more so about the Fed pivoting potentially in December and maybe only raising interest rates 50 basis points. I think it's going to be a very positive meeting, and I think that's going to move the needle in a positive direction for us here throughout this afternoon. That's what I think is going to happen. So we'll see here. How do we know that it's 75 basis points? It's being reported already. So the meeting itself is at 2:30 side of face, but we get the news right around 2 o'clock what exactly it's going to be. Okay, so again, it's all over. Breaking Federal Reserve interest rates by 75 basis points. But again, it's not so much this news. We need to hear it from this guy. We need to hear what he says and how the market responds to what this guy says. Because how does he frame it? What does he forecast for the future? All of these sort of things are important. We need to see what he says here coming up at 2:30. So Federal Reserve raises Fed funds rate by 75 basis point. There it is again. It's all over. It's all over the place. It's being reported live right now. Hey, there's us live right now on Twitter. Cool. Hey, anybody on Twitter, come on over to YouTube, man. Join us over here. Or you can hang out on Twitter, I guess. That's cool. So let's see. Federal Reserve hikes rates by 75 basis points to 4%, the highest level since January 2008. So we're getting a bunch of news here. There it is. Raised its benchmark interest rate by 3/4 of a point of a fourth straight time, but hinted that it could see, there it is. But hinted that it could soon reduce the size of rate hikes. That's what I thought was going to happen. Listen, we got to do another 75 basis point hike right now, but December could be better. And here's what I think. I think the next 2 months could get a little bit bullish for crypto. Now, we still might be in a larger bear market, but if he is hinting at reducing the size of rate hikes the next go around in December, what reason do we have to dial back? What reason don't we have to push forward a little bit? I mean, we have been sold off for a while now. I think most of the big players who wanted to sell, they've sold, in my opinion. They've sold. So let's pop over here and see if we are live. We're getting close, guys. We are getting close. Make sure you guys tap the like button or smack it, smash it, whatever you want to do. Really helps us out. If you forgot to do it, take 2 seconds, hit that like button for us, and subscribe. And here we go, folks. We are getting ready to hear from the man of the hour right now, coming at you, Mr. J. Powell, getting ready to take the stage here. And we're going to break it down here. So let's see if we got some volume here. No volume yet. We'll just keep the audio on. And we're awaiting the man to take the stage here. All eyes on Jerome Powell right now, guys. So all eyes on J. Powell. And welcome in, everybody. Only 23 likes. Are you kidding me? No way. There's no way there's only 23 likes. There's no way. Guys, we need this thing well over that if that's the case. Okay. Smash the like button. Definitely. It's totally free. Really helps us out. All right. So let's turn up the volume here. Let's see what happens here. All right. We're waiting on J. Powell. Still waiting on J. Powell. But yeah, big meeting. 75 basis points has already been the move, guys. It's already been the move. And here he comes, Mr. J. Powell. Ladies and gentlemen, please welcome Jerome Powell. Ladies and gentlemen, Jerome Powell.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate.
Not 75.
Moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
Okay.
In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Okay.
Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions.
Bitcoin's moving up a little bit.
Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected.
Whoops, sorry about
Price
that.
pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective.
It's going to take a while, but we've been hearing
At
that.
today's meeting, the committee raised the target range for the federal funds rate by 75 basis points.
Yep.
And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2%.
He didn't say it was going to be a 75 basis point hike in December.
Inflation have tightened significantly in response to our policy actions, and we are seeing the effects.
They're going to continue to raise them.
In the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences,
I think so too,
it
JK.
will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
That right there.
There is significant uncertainty around that level of interest rates.
Mm-hmm.
Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Yeah.
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
We're not dumping, guys. I don't know. People in chat, chill out. We're not dumping. I'm watching it. We're not dumping.
Better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay. All right. Let's see what happens here.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now
Good
and
question.
Let's say the December meeting? Or is that something that the Fed could potentially proceed with independent of that data?
That's a
given
really
the
good
lag
question.
effects that you mentioned?
That's a good question.
So a couple of things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Okay. Leaving the door open for 50 basis points.
With Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
Yeah.
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result.
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember though that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and
it's going to be a long haul,
and cover it we will.
Yep. But in December we might give it a 50 basis point hike to just
Nick Timmer,
maybe.
The Wall Street Journal.
Maybe.
Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people publish an assessment of underlying inflation.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley with New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year. They've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so
wish we would have started
the thing
increasing rates last year.
Standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Welcome in,
Chair Powell,
everybody.
Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly for a long time thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity, and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy.
Interesting.
Because the markets are thinking, what is the central bank going to do? And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them, but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy. And trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view.
No pausing.
To think about or be talking about
50 basis points.
We have
Could happen.
ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive. And we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell, Neil Irwin, Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of the labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. So we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. So, sorry, was I getting to your question there? The housing. Yeah. So We look at housing, of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline, and you're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very carefully, much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policy is.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers. And I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see. So I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because the data series is volatile. We never take any one reading. We always look at 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the US that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marti with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators like Elizabeth Warren are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust. And we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosure. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens. So there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending? I
don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts, or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again,
pretty flat.
If we over tighten, and we don't want to, we want to get this exactly right. But if we over tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now. And I think as we're farther along, we're now focused on that. What's the level we need to get to rates. And I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber, Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up in, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So, but I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense actually, because that for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. Okay, but at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message, it should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and that'll end when it ends. But there's no sense that that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have
not a pausing, but maybe a 50 basis point
in
December.
Is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, but, and, you know, people are, and, you know, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying and they're still, you know, they're fine. So I don't know how big the fiscal headwinds are. They haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that go and play into your thinking about the future?
Good question.
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects. Although I think overall, I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that, you know, our job is going to require some resolve and some patience over time. We're going to have to stick with this. You know, that's just we think all that is a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair
Last
Powell,
question.
Nancy Marshall Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. There's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data is a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. You know, again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be.
We're in one.
And you know, our job is to restore price stability so that we can have.
I mean, it could get worse, but we're in one.
Time, and that's what we're going to do.
Just real quickly, why do you feel like the window is narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up. And I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay. We are out of here, Jay Powell. Okay, I'm going to give some thoughts here. I think that's it. Yep. All right, that's it. So major takeaways for me here. What's up, everybody? Foxy, what's happening? Whoops, I wanted to go full screen. All right, major takeaways for me. And guys, thank you so much for hanging out. We're going to just kind of unpack this a little bit here for like 10-ish minutes or so. Drop your thoughts in here too. I want to bring everybody's opinions into the fold. Really appreciate everybody tuning in. If you haven't hit the like button, do so. Consider subscribing to the channel. If you're new here, welcome. We're here every single day for you, talking about crypto, talking about altcoins. Of course, we're always covering Fed meetings and what have you. So here was my major takeaway. Number one, 75 basis point move, exactly what we expected. Exactly what we expected. Let me go over to the overall crypto market. All right, and let me just pull up Bitcoin on this chart. Exactly what we expected to see was the 75 basis point move. Okay, we before the meeting itself. Oh, let me open this up. Sorry, you can't see that. Okay, before we started, Bitcoin at 12:25, 2 hours before the meeting, 2 hours before the meeting, we were at 20,392 per Bitcoin. So all these people in here are saying, oh my God, the market's dumping. No, it's not. It's actually extremely volatile right now. And we're actually above where we were before the start of the meeting. Now, yes, we did move all the way. Look at this. It's right here. We moved all the way up to 20,720. Then as the meeting progressed, that was 5 minutes into the meeting right there. As the meeting progressed, we came all the way back down to 20,400, still above where we were 2 hours before the meeting itself. Now we're on our way back up. So I think we're going to trend right in this $20,700 to $20,300 range because nothing has changed. Everything is exactly what we thought it would be. If we were a betting person here today, this is exactly the bet with the best odds that you can put your money on and feel the best about. And that's exactly what happened. Now, what I also gathered from this was the door is open. The door is not slammed shut for a 50 basis point move in December. That's what I'm getting That's what I'm getting out of this today. The door is cracked open. There's a slight possibility that that door might open up to a 50 basis point move in December. Or, in his words, this next meeting or the meeting after, we could see a reduction in interest rate hike for the short term. But over the long term, this is going to be a long process in order to meet their inflation goal. Meaning, we are going to see interest rate hikes well into 2023. Again, this is my opinion here. This is how I'm understanding this. This is how I'm unpacking this. Okay? Just my opinion. My opinion is a lot of the same from now until December. It's going to get pretty boring. We might have a little bit of positive momentum just based on the fact that the door is left open for a 50 basis point move. But in reality, it doesn't mean much. All it really means is just a subtle pullback in the interest rate hike. But as we move into 2023, and maybe that 50 basis points comes the first part of 2023. But in the end, it doesn't mean that much in the grand scheme of things. We're still going to see interest rates hiked, in my opinion, at least over the next 4 to 6 months until we get closer to that goal. So he's been pretty consistent with that, Jay Powell. So I got to say, I know how a lot of people feel, and it's like, oh, it's just political jargon and blah, blah, blah. And I know he doesn't answer some questions perfectly, and he jogs around some of the answers and what have you. But reading between the lines, unpacking it, that's kind of where I've come to be with this. It's, yes, we started too late. We should have started raising interest rates last year. We wouldn't have found ourselves in this hellhole that we're in 2022, but we're here, and we're going to be here for a while. It's going to be a long haul, and buckle up. And but here's the thing, from a crypto standpoint, how much more can we sell off? I don't know. I mean, a lot of people out there say Bitcoin's still going to 14,000. Are there that many people who haven't sold since we've been in terrible territory since June? Or has virtually everybody, gotten out of the market? How bad, will it get? Now, if inflation gets worse, okay, that's something different. But as long as we're seeing these incremental, now I'll bet they're not big changes, but as long as we small decrease that 9% saw in June, I do think we'll have a pretty flat crypto market with the occasional moves here and there, right? So that's kind of where I'm at right now. Does that make sense? Let me know what you guys think. I'm going to hang out here for just a few more minutes longer. So Zach, I heard a talk with Kevin O'Leary, and I really think he's right on. Love Mr. Wonderful too and his insights. He thinks until they have all the structure in with regulations in mind, we will stay in this range. I agree. I agree 100%. I think that is the next positive catalyst for crypto. And on that front, Caveman, I don't think we get anything on regulation from now until the middle of next year. I just don't think we will. Nothing set in stone. We might get more insight in what they want to do and what they're leaning towards. But once we have clarity on this front, I agree with Kevin O'Leary that that's when the big players will come in. And there are so many people out there that, say, we don't want regulation. We want to keep it decentralized. I hear you. I understand that. But at the end of the day, you could sit there and bitch, moan, and complain about it. But at the end of the day, you can't do anything about it. So the only thing you can do is prepare for regulation. From an investor standpoint, none of us in this room have the power to do anything about regulation or lack thereof. So why sit there and complain about it? It's a waste of time and energy. It's a waste of time and energy. Instead of that, use that same energy, use all that, pent up energy and drive it into a plan forecasting that some type of regulation is coming. That's what I'm doing. I mean, that's the only thing we can control as retail investors. That's the only thing we can do. We can't control what regulation is going to come or not come. We can't. We are not at that table. We don't have a seat there, right? All of us in this room, right? All we can do is understand that on the positive side of regulation, more big players will come in. We can be here before a lot of big institutional money comes into crypto. And I think that is a good thing. And I think when those big institutions come in, they will drive the prices of cryptocurrency up. And if we are in there before a lot of those big players come in and after regulation is set, then I think it could be a net positive for us as investors, right? That's kind of where I sit on that front. So let's see what else we got cooking in the kitchen. One day when crypto really becomes the hedge, it's supposed to be, we are all set for life. And exactly, it won't become that hedge yet. And I've been reading a lot of articles about this, Zena, because it's just so new yet. We're too early. In fact, I just covered an article from Brian Armstrong saying this exact thing. Of course, the CEO of Coinbase. He also believes that, crypto is the hedge. Bitcoin is the hedge against inflation. Eventually, we're just not there yet. Our markets aren't big enough yet to have those impacts. Eventually they will be, right? And the easy way to look at that is if Bitcoin is digital gold, like many people believe, if it is the reserve currency, if it is a hedge against inflation, like gold has been forever, that market cap still needs to 10x. Bitcoin's market cap still needs to 10x in order to catch gold's market cap. So that gives you an indication of how early we still are in crypto. And we're just not there yet. We're not there for Bitcoin to be a complete hedge against inflation yet. If anything, and this really is the first test, by the way, because inflation is running so rampant. So if anything in the market drops a lot, I will just buy more. Steven, what's up, man? Zach, when you get a chance, check out Senan Inu. Could be the next shift. I appreciate it, man. Travis agrees. Thanks, man. And guys, if you disagree, drop your thoughts in here. That's cool too. That's cool. Load your bags before they come in. Exactly. That's exactly how I look at it, V Diesel. That's how I'm looking at it, man. Crypto's the future. Get on board anytime you can while it's cheap. I think regulation will be a good thing. Yeah, I mean, I understand why a lot of people think it's not good. I get it. I know, because anything run by the suits is bad, and they'll figure a way to mess it up. But at the end of the day, we can't control what they're going to do anyway. I mean, we all invest in stocks, right? A lot of us invest in the stock market, and we know there's shit going on there that, but it is what it is. There's still money to be had there. And time in the market, in the stock market, tells us that the more time you put in, the more money you make. Same thing in crypto. The more time we could put in now and buy at cheap prices, when they figure out this whole regulation thing out, and a bunch of more people come in with big money, and financial advisors are able to sit across the table with their clients and say, hey, why don't you put 1 to 2 to 3% of your overall portfolio that's worth $5 million into Bitcoin? And that starts to have a trickle down effect, and corporations start putting a little bit of Bitcoin on their bottom line, on their balance sheet. Once all of that starts to come into play, we're already here. We're sitting. We already have a seat at the table, and we're in at cheap prices. That's the way I'm looking at it. And we don't know exactly how they're going to analyze and regulate every different type of crypto. Why do you think we always say diversify your portfolio? Don't go all in on one crypto. What if that one crypto gets in trouble with the SEC? It can happen. This is why I own 30 of the top 100. This is why I'm well diversified now, just as of this year, and I'm still learning, but guys, by the way, and I'm evolving with all of this, but I want stocks, I want crypto, and I eventually want real estate. I want a piece of the pie everywhere. And when it comes to crypto, I want a piece of different sectors. I want to piece together, in my opinion, where the top players are in various sectors. Because I don't know exactly how it's going to go down. But all we need is a few of those 30, in my portfolio's case, a few of those 30 to be really, really good investments, and we're going to win big. That's how I'm looking at it. And, a lot of that is in Bitcoin, Ethereum, Cardano. And then from there, it really branches out into a ton of other different altcoins in different sectors, doing different things, bringing different things to the table, filling different gaps, and what have you. Right? So, and look for up and coming companies, and when you're looking at the super small caps and the micro caps, tread very lightly, make that a small piece of your portfolio. And, that's how I see it right now. Right. But hey, I mean, we're all guessing. Okay. Nobody has a crystal ball. Nobody does. We're all guessing. Let's see. Appreciate you guys. Regulation will bring mass adoption. Yeah, I think there's some truth to that for sure. Well, BTC dropping right now. Bitcoin is dropping right now. Oof. Okay. Let's refresh. Bitcoin is dropping a little bit. 20,000. Okay. So now we're getting back to levels where we were we're getting back to these levels pre-meeting. So I think we're going to just trend right here above 20,000 would be my guess. We'll see. But we are getting a little bit of a sell-off now. A lot of volatility here, but I don't think it was good or bad news today. I think it was somewhere in between. And CoinMarketCap's all over the place. Their data is just all over the place. Let me go to CoinGecko. So this is still showing 20,400. I don't know if it's 20,200. It's hard to get really good data right now. There's so much volatility. This is still showing 20,400. Let me zoom in there for you so you can see that. At the end of the day, I mean, this meeting was kind of exactly what we expected, right? So appreciate everybody stopping by. Really, really do. Boca said, did Austin take a nap? I don't know. He was live there for a little bit too. I think he was live on the Clear Cryptos YouTube channel and his channel simultaneously for a little bit. So that was cool. We're going to be live together, Austin and I, tomorrow for an AMA at 6 o'clock Eastern. A couple members of the Clear Cryptos team. That is one of those up and coming projects that I really like. And they're not really a small cap. They've been over $150 million market cap here, dialing back a little bit today. People taking some profits, but I think it's just beginning. Infancy stages for CCX. And here's that chart right there. So we'll be talking a lot about CCX tomorrow, this project right here. And yeah, guys, appreciate you guys all stopping by. Really, really do. And have a fantastic, fantastic rest of your day. And we'll be back with, of course, more videos, live streams. Just had a Shiba Inu video go out right now. It literally just went out. So I'm going to end the stream. Go check out that video. Just went live. Crucial level where we're looking forward to the upside. Right now, SHIB probably dialing back with the overall crypto market, but I'll give you some support levels to watch and some resistance levels. So go check out that video. Thanks again, everybody. Enjoy the rest of your Wednesday, is it, right? Yeah. Enjoy the rest of your hump day. And we'll see you in the next one. Take care.